Welcome. I'm Catherine Magaña here with Greg Carroll, Steve Wolff, and Rachel Ivanovich. And first of all, welcome back, Rachel.
Thank you.
She took a little time off to be with family. Do you want to share where you went?
We went to Niagara Falls, and if you haven't been, you definitely need to go. It is a bucket list place to visit.
Nice. And I definitely think you needed that time away after
I
a
did.
crazy tax year and season, and now you're
was so
I say now
beautiful.
you're in 2025. So
Yes, I've finally made it.
yes.
So when the market crashes and everybody's in a barrel, they can go to
Niagara Falls.
Niagara Falls, right?
So let's see. The big news over the week, we're still looking at earnings, government shutdown. There was an election this week, tariffs, tax planning. So there's still kind of a lot of the same topics on the horizon. But I thought I'd start with a little bit on the government shutdown. So here we are, day 37, and I don't know when we're going to open back up, but I did see that the Federal Aviation Administration announced late Wednesday that it's cutting flights by 10% at 4 major airports due to the government shutdown. So it's interesting as we're approaching the holidays and travel, and I've heard a couple clients say that they're not going anywhere because they don't want to be stuck at an airport. So I don't know when this is going to end, but definitely it has impacted a lot of different areas of the economy. So hopefully they can come to some agreement sooner than later. So that
I think the airports, as they cut more and more flights, that's going to be a huge pressure on Congress.
Well,
to
it's
get
not just the
something
airports.
done.
I mean, people aren't getting paid.
They aren't getting paid
that
too.
too.
Yeah.
Well, but
Congress
is.
gets paid. That's fair, right?
That's totally fair.
I flew to Boston. It was fine. There were no layovers or
okay.
no.
So
yeah.
you can contest it
I
wasn't
can
bad.
contest it. It wasn't bad. It wasn't
Okay.
bad.
But that
Saying-
was what, 10 days ago?
That was about, yes, correct.
But I think most of these reductions are at the smaller airports right now. It's the big airports. If you're flying from a big one to a small one, that's a problem. But if the longer this goes on,
Yeah.
you're going to see it at the larger airports, I think. So
Well, and especially during the holiday season, that's when there's a lot of travel, and that's
Exactly.
where I think a lot more people will be impacted.
I actually think that there was a congressman who is trying to get a new bill put forth that says that if the government shuts down, then Congress does not get paid. Because I think if that were the case, you wouldn't see this kind of a shutdown.
yeah.
I honestly think that what's really tricky right now is the notices, because the IRS is still continuing to pump out automated notices. So clients are receiving just a plethora of notices because October 15th was, 3 weeks ago. I can't call. You can't
They're
call.
closed.
You can't. They are. They don't want us to write because there were no tax returns processed if they were paper returns from time the shutdown started so all of those returns are just sitting on someone's
wow.
desk.
So are you saying, so if we owe money, we don't have to pay, right?
That's
I would
not
just.
true.
That is not true. But
There's interest probably owed for the days.
what I am advising clients is that if you don't overpay, because getting a refund in the spring is going to be very tricky, I think. So pay only enough to cover your safe harbors.
And let them come after your money.
Well, you'll have to pay them by April 15th, but don't overpay and have $10,000 refund, and then you're going to have to wait a year to get your money. Is my fear is that refunds are going to be delayed.
So if the IRS isn't working, are they working?
They're not working.
Okay, so how?
There are a few essential workers, but you can't get through on any of the lines right now.
So how will people know what they owe and all that?
It's going to be interesting.
Okay.
All right, so just an update.
So wait a minute. So if the government's closed forever, we never have to pay tax again.
Yeah, yay! Good thing I joined your team. I'm going to be out of a job next season.
CPAs are done.
All right, so an update from last week. So today is November 6th, and over the last week, the markets are pretty much down a little bit from last week to this week. The Dow Jones is down about 1%. The NASDAQ down a little over 2% from last week. The S&P down about 1%, and the Russell 2000 a little under 1%. So once again, we're still up year to date with some of the different indexes. The S&P this year to date is up 15.55. The NASDAQ is still up over 21%, and the Dow Jones over 11. So even though it's pulled back a little bit over this last week, the markets are still up year to date. But that doesn't mean things will change between now and the end of the year.
So we have actually been anticipating this. I mean, nothing goes straight up and stays straight up.
Right.
All right. Catherine, you and I were talking a little bit this morning.
Right.
What a lot of people do is they look at their high water mark. And when the market falls, they say, well, look how much I've lost. That's probably not the best way to look at how you invest, because what you should start with is what you first put in. And where are you today? So if you were Rip Van Winkle, and let's just say you were Rip Van Winkle's half brother, and you only slept for 10 years instead of 20, and
Love the analogy.
thank you. And let's say you started with $1 million, and now I give you $2 million. And say, wow, I made $1 million, as opposed to, but I was at $1 million too, and now I've lost money. No, it doesn't work that way.
Well, and then you also have to remember earlier this year, at one point, the S&P 500 was down almost 19%. So when you factor in where we were the lowest and where we're at now, I mean, there's almost a 35% move, and that's not uncommon year over year. And so once again, to Steve's point, is there's a lot of times when you hit that high mark, everyone's like, that's where I should be. But the reality is it does fluctuate over
God-given right
over
to
time.
be right there all the time, at the high water mark.
So there are people now taking some profits. It's I think perfectly normal. Wouldn't shock me if we had a 5 or 10% correction. I think, Catherine, you said we're down 2% already. So it's going to feel, wow, 10% is a lot, but it's normal. Okay, so it's not something to get all antsy about.
And if you are nervous, there's a lot of ways that you can invest in the market and limit your downside, but you're going to limit some of your upside. There's a lot of different ways you can invest other than, Vince always talks about buying, individual stocks. And I think more what we all do is more portfolios, mutual funds, ETFs, manage accounts. So there's a lot of different ways to
one of the things we've
risk.
talked about before is structured notes.
Structured notes.
Obviously you need to understand it, and you need to talk to your advisor about it. But structured notes give you a way of protecting some on the downside.
Yep.
So there are ways to do it. For those people who understand options and whatever, they can use options to limit risk.
I like the growth notes for the structured notes too, because it, if it's 4 or 5 years, it kind of keeps the client more focused on 4 or 5 years and not what's happening every day. And so, I think those work very well for some of the clients that tend to get a little bit more nervous with the volatility that you see in the market sometimes.
Right, and I think you hit the right word though, volatility.
Yeah.
Volatility, first of all, is not risk. It's also not loss. Risk is something where you have a company maybe that doesn't have earnings and the stock just goes to the moon. That's pretty risky because, what are they really worth?
Yeah.
And volatility happens all the time in every asset class. It's not just stocks. It's just that you don't see shows a lot that says, oh, my house just went up by 0.25%. We all smile, but
I looked on Zillow. It's
right.
up.
But that's what we do with stocks.
Yeah.
So volatility happens all the time. It is not something to worry about. I think that it's interesting too. Stocks are pulling back, even though these companies have come out recently, and especially the tech stocks, with really good earnings, and actually saying that their earnings are going to continue to be good. But we've talked about that they're pretty richly valued. So hey, there are a lot of people, especially traders, who will say, let's take some money off the table. All right, but we don't usually trade stocks. We're more investors. We're saying that between now and 5 years from now or 10 years from now, or whenever it might be, we think that company is going to do well. Don't pay attention to the volatility. So that was really a good word, Greg.
Well, thank you, Steve.
I usually don't give you compliments, but that was a good word.
Take it and run. Just kidding. Okay, I want to give you a quick update of where we're at with mortgage rates. Their 30-year as of today, November 6th, is at 6.15, and the 15-year is at 5.69. So pretty steady. Slight movement, but pretty steady over the last couple weeks. And then our 1-year CD is up a little bit. It's at 3.65, and the 1-year Treasury right now is 3.7. So not too much change, but a slight change there. And then I know one of the things we like to report is it changes every week, but right now, based on the Fed Watch, we're seeing a 62.7% chance of a rate cut in December. Like we mentioned, that's down from a higher projection earlier, about a month ago, but it does appear potentially there could be another rate cut between now and December, but we'll kind of wait to see what happens over the next couple weeks.
Well, going back a little bit about risk and all that, I looked at the CNN Fear and Greed Index this morning, and it's down. It's down to 25. 0 to 25 is extreme fear. Okay, so it's just in that extreme fear category. if we go to zero, obviously it would be, I don't know what. I don't think it's ever been at
I
zero.
wonder if the government shutdown is making people more fearful because the market is only a couple % off all-time highs.
I think you've got so many cross currents right now.
So speaking of growth and appreciation and capitalism, some clients have some stocks that have appreciated and have some clients have large concentrated positions. And I know last week Greg touched on the donor advised fund, and Rachel, you're back this week, and I know we were just sharing that we've had several conversations. So I thought maybe you kind of want to chime in on that a little bit.
Well, before I jump in, Greg, I don't want to steal your thunder. And so what did you talk about last week as it pertained to donor advised funds?
Yeah, we just talked about that, there's going to be the tax law changes coming up in the next few years. Maybe if people are charitably inclined that, there is a way to actually kind of front load
Leverage
some of
that,
your donations, in 2025 to get the write-offs and then dole it out over the next few years. So it is a good way to, there's when you look at the tax deal and write-offs and the different income limits to be able to itemize over the standard deduction and stuff. There's a lot of things you got to look at. It's not as simple as it used to be. So.
Yeah. And we have had several clients contact us. Catherine and I have talked to them this last week in particular, who have had a windfall in income for 2025. That's the year we're in, right?
Yes. Yes.
Just finished the 24 returns.
I'm ready for 2026.
I know, and everyone's talking about 26. But so, for instance, we had a client who has been working 2 jobs, really, really working hard, and also had a sale of a rental property. And so their income is really high this year, and they're saying, I really just don't want to give the money away to the government. I'd rather give it away to charities, but I don't want to give it all away in 1 year. But I need the tax write-off in 2025. And so with the donor advised fund, basically you set up the account and you fund it, and you're able to take the tax write-off if you itemize in the current year up to certain amounts. And we can go into that in just one moment. But then the money can be doled out to various charities over the next few years, depending on the donor advised funds. The ones that we were looking at had a minimum of 5% of the account value. But I thought it was a pretty interesting way to minimize taxes if you have a really big year and you are charitably minded.
So you can kind of itemize this year.
Correct.
And then take the standard deduction next year if your income's
Correct.
back down. And
yeah. So what we were looking at for her was where's the sweet spot, and we came up kind of with $150,000 to fund this donor advised fund. Mm-hmm. She'll get a write-off for the $150,000, thus bringing her income down, and then over the next however many
very
years.
Nice person.
Yeah, she's a very nice person. Yes.
And we looked at the whole plan and made sure that this made sense.
That it worked.
It worked for her. And then also the beneficiaries on this account were charities, and so it just
made sense for her to give it away during her lifetime and actually see the good that her donations were doing.
Yep.
And so one of the things that we were looking at specifically for her had to do with appreciated stock. Mm-hmm. And so you can gift appreciated stock even if you don't have a donor advised fund and you don't pay the capital gains tax, and the charity gets the benefit of the full fair market value of that appreciated stock. And you can also gift other appreciated assets, but that's a whole other podcast.
I find it fascinating how much money Americans give away,
Yes.
to charitable endeavors without necessarily being forced to do that. It's what they want to do.
Well, especially as we're wrapping up the end of the year with the required minimum distributions, and I'm seeing more and more clients are doing their
qualified charitable distributions, yeah. So that income's not included in their taxable income for the year.
But I think I've seen more and more clients actually using that.
We've been talking about it a
for a while.
lot
I know.
on the
This
podcast.
year we mentioned it a lot.
Because
I've seen an increase in my clients setting
That
those
are
up every
yeah.
year now, too.
Because I think people didn't, some people
Realize.
don't even realize that they can do that.
Right.
Or a portion of their required minimum. So,
Yeah.
But you still have to be charitably minded to do that.
yeah.
Sure.
There's a lot of people say, hey, I don't want to give anything. I'd rather give it to my kids, than to some charity.
But for instance, these 2 clients that we're talking about, they don't have any children. And so their
Would
intention.
they like some?
Right? I have a few. Yeah. So, but an interesting concept. Call us if you want to discuss that.
Okay. What else has gone on here this week? Anything that we should discuss?
We've talked about this a lot too, is we've been looking at a lot of partial Roth conversions and looking at some of those numbers. And for some people, it makes sense to do partial. For some, it does not. It's not a one-size-fits-all, but we do find occasionally it makes sense to at least consider or look at that.
And we were looking for a client this week, and I mean, there were a couple of different interesting strategies that we were talking. No, we were talking about doing Roth conversions, but doing it aggressively instead of doing, looking at the tax brackets and saying, okay, well, this client's in the 22% tax bracket. Let's not let that tax bracket go to waste, and so let's convert just enough for her to stay in that tax bracket. But then we were looking at, okay, well, what if instead of doing 30,000, we were to do 150,000? So aggressive, and then it boiled down to the goals for the client, and did she want to leave this legacy to her children? Or what does it make? What makes the most sense for the
her
client
situation,
for her
yeah.
situation?
And do you want to pay the taxes, or do you want your beneficiaries to pay taxes?
Exactly.
Right. And so but we were, considering the Medicare surcharge, and I mean, there's so many factors that go along with that conversion that it's not a one size fits all, and it definitely makes sense to give us a call for us to look at your individual situation.
It all comes down to taxes, doesn't it?
Yes, it's always taxes in there.
Yes, death and taxes.
This world would be a lot easier without any taxes.
One of the other things, you mentioned how interest rates are coming down, Catherine, and I was looking at money markets. A lot of people have a lot of money in money markets, I think, and they were over 4%. Now they're under 4%, and they're probably going lower because they really haven't adjusted for the last rate decrease from the Fed, and maybe we get another one in December. There's a lot of talk about one or two more next year, and we talked about structured notes for growth earlier. We do a lot of structured notes that produce nice income as well. So basically a structured note is a bond, and we usually structure them out a couple of years, 3 to 5, usually 3 years. They usually last one because they have a callable feature, which allows the banks to call them back. But we're getting still over 8% on those. So for the right situations, we might have opportunities to, bump up that income level a little bit without adding too much more risk.
Yeah, and with markets as high as they are, especially if you're putting new money to work, you talked a little bit about the structured notes that have growth potential, that also have downside protection.
Right.
I think those are pretty interesting. Yeah. Again, it's got to be for the right person, the right situation, but if you can get 10, 15, 20% downside protection in a market that is a little bit overvalued, that should give you the ability to sleep pretty well at night.
Yeah.
So, all right. Well, this is a wrap-up of another fantastic week. And let's see what happens. Let's see if the government opens up again at some point in time.
I hope so.
Part of me hopes it doesn't, but
we need the tax forms for next season.
No, I kid around with that. I mean, obviously, we want people to get paid, but sometimes I think that the government is so big that I really wonder if we need all of the what's there. Let's cut off the extraneous stuff, and like you were talking to, let's help those people who truly need help.
Yeah.
I think
what I don't get is how is the military not essential services? How is that even a thing? They should absolutely be paid. They're protecting everyone else in the country, and yet Congress gets paid and the people protecting us don't. It's the most bizarre, dynamic.
I agree. Now, weren't you in the military?
I was.
What were you? Army?
Army.
Wow.
Yeah.
You were in the infantry?
I was field artillery.
All right. So that gives you a great background for being a financial advisor.
It does. It gave me great motivation to become something else because, that's...
No, I mean, when you're ducking all the bombs that hit, it's kind of like, ducking all the stuff that happens in the market.
I don't know if that's a perfect analogy.
Interesting
but
analogy.
I guess it is one.
I like to do the analogies. All right. Anyway, that's a wrap up for this week. Thanks again for listening, and we'll see you again next week. Happy investing.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.